Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. Well, with reporting season well and truly behind us, it's worth asking, should we be cautious or should we throw caution to the wind? Well, interest rates are low, and inflation is showing little risk of breaking out despite emerging economic and employment growth, or the re-emergence of animal and entrepreneurial spirits. Around the world, growth appears to be stable, and central bankers, from the European Central Bank's Mario Draghi to the US Fed's Janet Yellen, and from the Bank of Canada's Stephen Pulitz to the Bank of England's Mark Carney, all are suggesting ultra-low interest rates and accommodative monetary policy have done their job. Unsurprisingly, jawboning markets to expect imminent interest rate increases has been evident since the start of the year, but inflation remains stubbornly low. In the US, where the Fed aims for 2% inflation, it sits at just 1.4%. And this is despite unemployment halving since its post-GFC peak. When Janet Yellen raised rates in June by 0.25%, she said an across-the-board decline in US mobile telephone charges in March had a one-off timing effect. It affected spending costs, and those effects were strong enough to impact the consumer price index. Regardless, the tension between the bulls and the bears surrounds inflation. On the one hand, many believe economic growth is about to accelerate, driving jobs, wages, and ultimately inflation, and in advance of this, central banks will have to raise rates. Initially, the accelerating growth, combined with rising but still low interest rates, is bullish for growth assets such as shares. This is the reflation trade you hear so many people talking of. On the other hand, there are those that believe the absence of inflation is suggestive of tepid growth and a fundamentally weak economy. And when combined with high levels of debt, any increase in rates could trigger defaults, a decline in consumption, and ultimately a recession. Now, I'm not sure which camp you're in. The fact is, we have no better reading on the state of the global economy than anyone else. In fact, it may be the case that the less you know, the better you'll be at navigating the inevitable vicissitudes of the economy. What we do know is that it's folly to be all in or all out. It's much better to manage by degrees. Those degrees can be determined by any number of factors or characteristics, but we reckon one of the best is the difference between price and value. The higher the price is above value, the less enamoured you should be about overstaying the party. Keeping in mind that value investors are the nerds at that party who tend to go home early, it's safe to say we think prices generally are stretched. This is perhaps best illustrated not by the record prices for art or wine or New Zealand stamps recently and New South Wales low-digit number plates, which I've alluded to you recently, but by the Argentinian bond issue just a month or two ago. Anyone with any knowledge of the history of Argentina will know that that country is an economy that can be characterised a number of ways. But none of those ways can include the word stable in the description. In the last 90 years, Argentina has endured 3 periods of hyperinflation, with the worst of 5,000% per annum occurring most recently in 1989. The country's experienced more military coups, followed by civilian uprisings than are worth counting, more foreign investment flows in and out that resemble tsunamis than anywhere else, and as recently as 2001, the country declared the then largest ever sovereign default. Only last year did Argentina finally emerge from that default. And why am I telling you this? Well, little more than 12 months after emerging from its most recent default, Argentina has issued a 100-year bond. And what's special about this issue is the fervour with which investors have piled in. According to Reuters, Argentina sold $2.75 billion at a final yield, but received $9.75 billion in orders. That final yield was 7.9%. Now that's just 5% more than what investors are willing to lend to the US government. The question you should ask is, do you think there could be or will be either inflation or a credit event or rising interest rates in Argentina in the next 100 years? If the answer is yes, which of course it is, then bond investors holding to maturity are going to have to endure some serious pain. And investors not holding to maturity may find a few other party revelers trying to reach for the exits at the same time. Markets move from underpriced to overpriced based on fundamentals, with the extremity of those price changes determined by emotions. Those emotions can in turn be seen in the pricing for risk. In the case of Argentina's 100-year bond issue, the fact that there was any desire to hold 100-year paper is reflective of either 1, an inability to price risk, 2, a desire to assess it on a relative basis, or 3, a desire to ignore it completely. In the stock market, investors appear to be playing a relative game too. The market generally is expensive, and investors are justifying it on the grounds that interest rates are low. If you consider US Treasuries are trading at 2.15%, they're effectively trading at 46.5 times earnings with no growth. So if you can find a stock with earnings growth on a P of less than 46.5 times, it's reasonably priced. But of course, this is a relative assessment only. As soon as rates rise, the apparent value vaporises. Now, we can't say whether we're early in our assessment of asset markets around the world being excessively priced. We can't even say we'll be right. And the market does have a tendency to be wrong for much longer than we can stay liquid. What we can say, however, is that managing by degrees works, and generally, conditions now do require a degree of caution. That's all from me this week. Be sure to follow us on Facebook and Twitter, and I look forward to seeing you again next week.